If I have a time machine and somehow you drop me 10 years before, there's one thing I'll change about investing. And whatever you're thinking is not probably right. There's a playbook, there's a thing that wealthy people use. They have a system that works whatever the market is doing. Doesn't matter the market is crashing, doesn't matter the market is booming or the market is going sideways. In this video, I'm going to give you a 5-step playbook that you can use to invest with confidence and avoid expensive mistakes. And if you're new here, my name is Charan and I'm working on making this YouTube channel the world's best one-stop financial channel, where you can come and learn about money, investment, making wealth, or just general saving. And if you can subscribe to my YouTube channel, it will mean the world to me so that it can reach to more people and I have a motivation to provide more value. So the first step in this playbook is that get the money to invest. You can't invest your money if you don't have any money to invest. You didn't save anything, you're just spending whatever you're earning. So the simple rule I follow is that I at least invest 15% of whatever I'm earning. So I'm spending 75% and I'm saving 10% for my emergency fund. And if I can go back, I'll be more aggressive with my investments. Let's say I'll invest 50% of my income and spend 50%. And in investing, there is an important term called emergency fund. You can't be missing your emergency funds because whenever the things come up, let's say your car broke down, let's say there's a family emergency, there's a hospital bill. Some people, they have to sell their investment to cover those expenses. Let's say you invest your money in S&P 500 SCHD that's giving you money every month and you sell your investment at a loss or even a less profit. It will be not worth it your time that let's say you're investing from last 5 years that you have to sell your investment at very little profit. So you need to have an emergency fund at least 3 to 6 months of expenses. And I know that if I have an emergency fund, I invest more confidently, I am more excited about my returns, and I have a peace of mind. So emergency fund is a really important thing when you're investing. And another thing in step 1 is that ABB, the term I always use. Always be buying. So it doesn't matter if the market is crashing, doesn't matter if the market is booming, if it's going sideways, whether Trump is in the politics, whether he's imposing new tariffs, whether Joe Biden, he's coming into presidency. So it doesn't matter whatever the economy is doing, you always need to be buying. And that's the thing I just recently started doing approximately 2 years ago. And I wish I started when I first started investing. So you always need to be buying, doesn't matter whatever the economy is doing. And it doesn't matter whatever the amount is. Let's say you put your investment into auto deposit directly from your bank account to your investment account. So you never miss the payment. And what else you can do is that whenever you get paid, you first put your money, whatever you earn, into your investment account and then spend the rest. That way, you know where you need to spend and where you need to invest. Step 2 is that always know your goal. You shouldn't be investing or you can't be investing without a goal in your mind. So your goal can be a cash flow, your goal can be a growth, or you can have a goal of mix of those. So when you're starting, I always recommend you have one goal in your mind. So let's say my goal, it was growth. Your goal can be to have a cash flow. And if you have a goal of growth, then you need to invest in S&P 500 or QQQ ETF or the most growth stocks like Nvidia. So you will have more growth than more cash flow. So let's say your goal is to have a cash flow in your investment account. So you need to be investing in dividend stocks. You need to be investing in ETFs like SCHD or stocks like Chevron, Shell that pay good dividend. And you can always mix and match later, but I recommend starting with the one goal and then move on to the other one so you don't get mixed up. And for my Canadian friends, if you invest in US stock market like many of us do, let's say you invest in SCHD. So I want you to invest in RRSP account, not tax-free savings account, so you don't get double taxation. Let's say you're investing in any US stocks that you're going to invest for long term, let's say 20 to 30 years or even 10 years. You need to be in RRSP account because whenever you get dividend and you reinvest them, you don't get any tax. Or whenever you go to your taxation or whenever you go at the year end to fill the tax, you don't have to file taxes. So always invest in RRSP, then tax-free savings account. Now after deciding your goal in step 2, your next goal is choose your strategy. So there are 3 strategies basically. One is passive investing, second is outsourcing, and the third is active investing. And what passive investing is that, and that's what I personally do, is I just put my money into auto deposit and they get from a bank account to my investment account every week or every bi-weekly. And you don't have any financial advisor, you're not picking up the stocks, you're not doing trading. So you're just passively enjoying the returns, enjoying the growth, and enjoying the cash flow. Now let's say if you have a question that if I buy a house and I put it on a rent, that's also passive investing. But if you look deep into it, let's say you put it on rent and something broke down, some leakage happens, then you have to go fix yourself, or you have to call somebody and then pay them to get it fixed. So that's not fully passive income. Passive income is that you just invest your money and now you're just enjoying the returns. But if you're a really big fan of real estate, invest in REITs and they give you 5 to 6% every month. So REITs is a good investment if you want to invest your money into real estate without getting a call from your tenants or going in a night to fix something up. REITs is a good investment. The second category in this step is outsourcing. So let's say you go to the bank or you go to the robo-advisor and they invest your money for you. So I'm not a big fan of financial advisors because they have a huge cut and it make a huge difference in the future. But let's say some people still do it and they like to do it. They just want to be out of the thing and then give their investment for a financial advisor to invest. So now let's say you're trusting your financial advisor. I always want you to make sure that your financial advisor is giving you at least 14 to 15% of return. Now, if your financial advisor is giving you only 10% return and he will deduct fees like say 2% or even 1.5%, that's only 7% return at the year end. And at the long term, let's say you invest for 30 years, $500 a month, and without a financial advisor, you will have $2.2 million. But with a financial advisor, you will stuck at $1.85 million. So that's the difference of $250,000 approximately. So you need to make sure that your financial advisor is giving you 14%. So at the end, you end up at the same investment that the passive investor is. And the third category in this step is active investing. I sometimes now do it. I used to be completely passive, but sometimes I do active investing. That's like, let's say Nvidia is coming up with the earnings and I know that the stock will go to $200. I'll just put my money in Nvidia. And I put my money in different stocks. Let's say now CNR, it's a great opportunity to buy the stocks. It's at, I think, $135 and I know it will be at $175 in the near future, 1 year or 2 year. So I look into a stock which I see is undervalued and invest my money in. And that's active investing. So you're going beyond the ETF that you're investing passively and you see the growth opportunity. It doesn't matter if it's 2 years, 5 years, 10 years, 15 years. And somehow you get more return than your passive investing. So for the passive investing, my goal is 11%, 10%, 12% on a good year. But if I'm doing active investing, if I'm taking stress, if I'm taking my time to search the stock, and if I'm taking my time to look at the news, then I make sure that my return is more than 12 to 13%. I want my return to be 16%, 17% because all the stress I'm taking. And as I said before, you can always blend them. You can be an active investor, you can be a passive investor, or you can be a mix of two. And right now, personally, I'm a mix of two. So I have a passive investor in ETFs like CHD, SPY, QQQ, and I'm an active investor in individual stocks. So you can be both. There's no hard and fast rule. Now the step 4 is that you need to design your portfolio. And I know in the starting, it's not possible for some people. So let's talk about how to design a portfolio. Now let's understand how I personally design my portfolio. So when I talk about diversification, everybody knows that diversification is really important when you're investing your money. So when one asset class goes down, you have another asset class to protect. So what I personally do is that I have some investment in real estate. So let's understand that. Now you're investing in S&P 500, you're investing in other ETFs, and now you say that I'm going to invest in blue chip stocks. So that's not a really diversification. That's the same asset class, but what I am emphasis on is real estate. So I have money invested in physical real estate. That's different asset class for my cash flow or for my growth perspective, or depending on how active I want to be. And the third asset class is stock and ETF that we talk in this video. That's my core investment that's give me stability, that gives me cash flow, and that's a completely passive investment and active at some places. And the fourth asset class is speculative. And it's a really small thing in my portfolio, let's say cryptocurrency. I have some money invested in Bitcoin, I have some money in Ethereum. So for the speculative side, I have some small amount invested in cryptocurrency. The fifth class is hard edge. So let's say I have some money invested in gold. So that means I don't have a gold ETF or a gold stock. I have a physical gold that I have in my bank, and it gives me peace of mind and it gives me security when the world goes crazy. So from this step 4, we are trying to see, or we are trying to think how wealthy people invest their money. They don't put all the money in stock market. they have a different classes they invest their money in. So that's where we learn. They invest in real estate, they invest in stocks, they invest in gold, they invest in different asset classes. And if you're a beginner, I don't want you to get stressed and start investing your money into the things that you can't even afford and then get in trouble. You can start with stock market. Once you get stable, once you get good job, then you can go into the different asset classes and you can always diversify. Just keep in mind how wealthy people invest their money. And the last one, fifth one in the list is sell. So I'm not a big fan of selling my stocks, and especially if I'm getting a cash flow from the dividend or a growth from my ETF, I'm never gonna sell them. I'm gonna enjoy the growth, I'm gonna enjoy the compounding effect. So I'm not a big fan of selling, but the important thing here is that how wealthy people think when they sell their investments. And the main thing is that in real estate, especially when they sell real estate, they have to pay huge amount of tax on their capital gain, especially if they sell within 2 years. So let's say you bought a property for $200,000, now you sell it for $350,000. So at $150,000, you have to pay taxes. And how some people save their money is, let's say they sell a property for $350,000, now they upgraded their house, they bought another house for $500,000, so they save the tax there. So this is a tax strategy, and I'm not a financial advisor. I recommend you always work with professional accountant or CPA if you want to save some tax, if you don't want to give all your tax to the government. But the point here is that wealthy people, when they sell their investment, they always think about how they can pay less and less tax and have more money in their pocket. So our 5-step playbook: first is have money to invest. Second is you need to have a growth or you're looking for a cash flow. Third is what's your goal? You need to know your goal. Fourth is simple asset classes. You need to diversify your portfolio. And the fifth one is selling roles. And if this helped, please share this video and like this video, and please subscribe to my YouTube channel. It means the world to me and I really appreciate you guys.